Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focusing on clients who recognize the need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, July 21st, 2025 edition. Let's get started. We start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, where we think we're going from here. Over the past 2 weeks, the stock market rose about 0.28%, which brings our year-to-date gain to about 7.06%. As far as what's working, what's not working, we haven't done this for a little while, but the sectors that have performed the best are industrials and utilities, followed by information technology and financials. It's really interesting in this year where typically when we have an expansion, we want to see the sectors like information technology and financials leading. But this year we've got industrials and utilities that are leading. If we are trying to get back to a made in America stance with this administration, that makes sense that industrials would be doing relatively well. Some companies like General Electric, some of the aerospace and defense companies, especially with all the wars and conflicts going on around the world, not surprising to see those doing well. But industrials overall is only about 8.5% of the entire stock market, so it doesn't really have as much of a contribution to pushing the entire market forward, as opposed to information technology, which is almost a third of the entire stock market, followed by financials at 14%. Utilities are interesting because typically we don't want utilities leading. It generally is a safety or defensive sector where if that's doing well, it's because we're afraid we're in a recession or going to a recession. But where so many of these companies that are investing in artificial intelligence and they're building these data centers, they really are needing a lot of power. And they're getting into individual private deals with some of these utility companies in order to facilitate the power generation needed. So again, we're seeing utility companies doing well, and then information technology and financials. If we look at individual stock positions and really what's powering the entire stock market, it's going to be some of the usual names that we've seen over the past few years. NVIDIA at number one, Microsoft, Broadcom, Meta, Palantir up over 100% so far this year, which is nothing short of amazing. JP Morgan's doing well, Netflix, Oracle, etc. What's interesting again to me is that the top 10 companies make up 78% of the total growth in the stock market this year. So again, where we like to see that the stock market's doing well, but when it's only being driven by a handful of names, if those names don't do well, then it can have the opposite effect. What's interesting on the back end, right? Apple, United, Tesla, some of these larger companies that are, they're not necessarily doing well, United's doing pretty horribly, but um, you have the contribution to the total return. So if Apple was flat for the year, we'd be up another 1.3% in the market. So it's interesting that we have these companies that can have a drag as opposed to the pull from the ones that are doing well. So that's where we are so far this year with the stock market. Next, we look at interest rates as measured by bonds issued through the U.S. Treasury Department. We believe that interest rates are the preeminent measure of investment risk. Rates are factored into every investment calculation, including stock valuations. Generally speaking, higher interest rates lead to lower stock prices, and lower interest rates lead to higher stock prices. And these rates will move up and down on a daily basis for a variety of reasons. So again, our job is to figure out what moves we've seen, why we've seen them, where we think we're going from here. We've got over here on the left-hand side an interest rate in nominal terms. We've got on the bottom axis maturity lengths from 1 month all the way out to 30 years. So each dot represents an interest rate for a given maturity length. Over here on the short and medium term, really not a lot of change over the past 2 weeks. We did see some increase in rates over the longer term maturity. So this green line is where we were at the end of market on Friday, July 18th. and the brown line is where we were 2 weeks ago. Interest rates do move up and down throughout the day. So generally with the stock market, we see a lot more fluctuation or movement because that's just how we have this set up. But with the interest rates, we're looking at multiple rates over a 2 week period of time. And so we could have individual charts for movements of all of these, but it's easier to contextualize it. It's in this format. It's more of a snapshot of where we were 2 weeks ago, where we are now. And generally speaking, interest rates don't move as much. There's not as much fluctuation on a minute by minute basis. That's just not the way that the interest rate market's set up. So anyway, very interesting. There's not a lot of explanation other than we think that there's an expectation that interest rates may stay a little bit higher for longer, which we'll get into in a little bit. As far as the prediction markets or the futures markets and where we think the Federal Reserve is going to land with interest rates here at their next meeting on July 30th, we got about, we'll call it a 5% chance that they're going to reduce the interest rate at their meeting in July, but almost a 2/3 chance at the meeting in September they'll reduce it by 0.25%. All right, as far as the news goes, it was relatively quiet again for the past 2 weeks, thankfully. But some of the things that we thought were worth sharing, Trump did get to his July 9th deadline for tariffs and then extended that again another 4 weeks to August 1st. And it sounds like we'll have to wait and see what actually happens if he extends it or not. It kind of sounds like he's going to be imposing tariff rates for certain countries and then still open to negotiating with some of the larger trading partners. But we are of the opinion that when we get to August 1st, we'll have a pretty good idea of what the tariff rates are going to be for most of the trading partners. There was a little bit of speculation that President Trump was going to fire Jerome Powell from his chairmanship of the Federal Reserve, and also rumors that Jerome Powell may resign. Both of those individuals refuted those claims, but we did see some fluctuation in the stock market as a result of those stories coming out. We think that he will remain in his term until it ends in May 2026, but again, that could always change. We had NVIDIA announce that they are going to be allowed to sell some chips in China that had previously been banned, and that led to their stock price going up several percent and really helping propel the market forward, as we've already mentioned. And then also just on Friday, President Trump signed a bill for stablecoin. We honestly don't know a lot about this, but there are some very enthusiastic people out there who believe this is going to change finance and how we do things forever. So this is something that we are needing to take a look at with some diligence. Having said that, it's very interesting. There's kind of under the radar stories. I wasn't able to find anything specifically, but it does feel like there are a lot of changes in personnel at some of these larger firms. There's people who are leaving Apple and going to Meta, for example, for artificial intelligence development reasons. And so we're trying to pay attention to where these chess pieces are moving and what that's going to potentially mean for these companies going forward and what their direction is and what they're trying to do to drive additional revenue and profits into the future. But for now, it's just kind of interesting, something, again, under the radar that we'll be paying attention to. All right, we'll run through some of this economic data that came out over the past 2 weeks and then get into our expectations and implications of where we think we're going. So first, we had inflation readings, consumer price index. It was up 0.3% for the month of June. This is the past 5 years worth of monthly data and the changes that we've seen. We did have a decline in monthly changes in the first quarter of the year, but we are definitely seeing increasing month-over-month changes in the second quarter. If we look at the changes on a table, we've got 0.3% being the highest reading on a monthly change since President Trump took office back in January. But we are coming off some increasing inflation at the back end of 2024 and into 2025. So if we were to sum the first 6 months of the years, that's a 1.2% increase, which if we annualize is a 2.4% inflation rate, which Federal Reserve wants a 2% rate. That's their goal. That's their standard that they've held to for a long time. This is the year over year change in consumer price index, which came in at 2.7. As again, we can see where we came from here back in 2022 down to where we are today. We kind of flatlined here right around 2.5, and we are definitely seeing an increase in inflation off the last couple of months to the 2.7%, which a lot of people are attributing to the tariffs that President Trump is putting on other countries. Now, we think that it has less to do with tariffs on the goods that are being imported because, right, core goods making up 0.15% on that inflation rate, where core services is the vast majority of what we're seeing an increase, right? So we'll call it 2 of the 2.7 is in core services, and there's more to do with how much we're paying people to provide those services for us than it is about the goods that were being tariffed or taxed or however you want to talk about it. But energy is one of those things that if we could get energy prices to come down, that could also help counteract some of the increase in other areas and maybe get us closer to that 2% level. But for now, most people are expecting that that inflation rate will continue to trend higher, closer to 3.5%, unless we get some dramatic changes in these tariff rates that President Trump is implementing. Because if we are going to tariff other nations and the goods that are imported, and we're going to then try to produce things here, it's just more expensive to produce them here in America because we have to pay Americans to provide those goods and services. So um, anyway, so we would not be surprised if we do see inflation in the second half of the year get closer to or even surpass 3%, which is not enough to break the economy, but it's still more than we would prefer to see. Second inflation reading is Producer Price Index, or PPI. That came in at 0% month over month, which it usually goes hand in hand. If producers at a wholesale level are paying more for goods and services, that we would see the increase in consumer or the retail side, or vice versa. If we're not seeing any change in the producer side, then we would expect to see some uh, relief on the consumer side, but that has yet to play into it. So I guess the counter argument to an increase in the CPI would be that producers are not seeing the same increase, and so maybe we are overestimating what is going to happen on the consumer side. Maybe we'll be surprised at a return closer to the 2% level. As far as other items, we had mortgage applications relatively unchanged over the 2 week period. We did see housing starts come in at a higher um, level than we had anticipated, as well as building permits. So we are seeing some additional units being created and permitting, which is indicative of future activity in the housing market. So we're hopeful for that to maybe provide some more supply, which can help generate some more activity in the real estate sector. We did see industrial production and manufacturing production increase in June. We had retail sales that actually were significantly higher than what we had anticipated. So people are still out there spending money, maybe even money that they don't have. And so whatever increases we're seeing in inflation have not yet had an impact on consumer spending because we're still out there spending more than we anticipated. Jobless claims continue to decline. Continuing jobless claims continue to decline. So again, the consumer seems to still be in good shape. They're still employed, they still have jobs, they still have rising wages, and they're still spending that money, which we know is a significant portion of the economy, and we think that's going to continue going forward. So again, we think that the economy is showing signs of growth. It is helping to keep overall volatility in both the stock market and in interest rates low, which helps the stock market move in an upward direction. So 2.28% for a 2 week period isn't fantastic, but if we were to get that every 2 weeks over a year, we'd have a really good year. So we don't need 5% gains in 2 week periods. We just need to have slow, consistent growth, in our opinion. So We think that what we're dealing with more than anything, we've been dealing with this for 6 months is the headline risk, right? What's going to come out over the weekend, or what's going to happen from one day to the next? What's that next headline or post on Twitter or X, or Truth Social, or whatever it is that's going to have people say, wait a second, and either sell and wait to see what happens, or something worse. So as long as we've got that headline risk, that's kind of where we think that the risk is the greatest, and we're trying to position accounts. Number one, diversify them so that we're not 100% uh, subject to the risk of the U.S. stock market, but also be positioning so that if we do see some volatility, that we can capture uh, investments at a lower price, temporarily at a lower price, because headline risk again is very temporary, and presents good opportunities to buy a high value asset for a low price. Um, we do expect interest rates to go lower. We would welcome a decline of 0.25% at their July 30th meeting. We think that there's enough evidence to suggest that we would want to normalize interest rates. We think that where they are right now is still a little bit higher than what the economy suggests that they should be. So we would like to see them reduce those rates, and as opposed to doing larger cuts down the road. Um, we still also expect Jerome Powell will stay in his term until the end of May next year. We think that the biggest issue for President Trump is we have about upwards of 20% of our national debt is financed by these short-term treasury bills. And when you have higher interest rates on those short-term bills, it's higher expense. And so if he wants to lower the deficit, or take credit for lowering the deficit, or having that money to spend in other areas, he needs to have lower interest rates. It's just the same as refinancing a mortgage when interest rates go down. Just imagine how many billions of dollars the government would save if we had a 1% reduction in those interest rates. So, um, again, the tariffs we think will be implemented by August 1st for the majority of trading partners. There may still be some deals that get worked out, but we think President Trump wants to get beyond the whole tariff thing and move on to bigger and better things. We also wouldn't be surprised if the Fed concedes to that 2% inflation target and instead says we're going to have a range. So maybe it's 2 to 2.5 or 2 to 3%. As long as inflation is within that range, that could give them the ability to adjust interest rates and not be outside of this mandate that they've imposed on themselves. And ultimately, finally, on the tariffs, we mentioned this a couple months ago, but we think that the higher tariff rates for the majority of these countries are going to be split between the foreign producer, the U.S. importer, and the U.S. consumer. It'll be different for every product and service, but we don't think that 100% of the tariff is going to be passed on to the consumer. So, yes, we anticipate inflation could go up for some things, some areas, but we don't believe it's going to be so dramatically burdensome for the U.S. consumer that it will end up breaking the economy or breaking us down into a recession. So, we anticipate slow growth. We anticipate the stock market will continue to trend higher. Interest rates will trend lower. And so we feel like we're pretty well positioned to capture gains from that scenario. All right, as a final word, I went camping with my daughter this last week for a girls' camp. I'm not a big camper, as many of you know, but the opportunity to spend some time with my youngest and be around her friends and kind of tease her a little bit maybe was an opportunity that I just couldn't pass up. And we were at a place called Wallsburg. It's in Provo Canyon here in Utah. I'd never been there before, but it's not really near a lot of water, although I could hear some like a river going through the campsite. And that first night, I'm sleeping in my truck and a thunderstorm rolls through, and with all the video of like, flash floods, especially in Texas, um, I kind of panicked for half a second, thinking, well, what's going to happen if we have a flash flood here? The girls are going to get swept away. I'm in my truck, but I still saw homes and vehicles getting pushed around in these floods in Texas and thinking I'm not even safe in my truck. And it just you and they had warning systems, but they weren't sufficient. Like they just didn't think it was going to have as much rain as it did, et cetera, et cetera. So you do your best to plan for these kinds of events and have warning systems and alert systems in place, but you can't always mitigate every risk or every potential scenario. And same is true with investments, right? We try to diversify, we try to invest according to what we think the fundamental analysis shows. And most of the time we're fine, but there's always that headline risk, right? It's whether it's a tariff by President Trump or maybe a nuclear weapon gets set off somewhere, or there is a major natural disaster that messes up our infrastructure, or a cybersecurity event that takes down our electric grid. Like there's so many things that could potentially happen. We just can't adequately prepare for. But we do have systems in place for your investments to try and mitigate when we think that there's going to be a structural breakdown in the economy, so that we don't end up getting uh, dragged through the mud, so to speak. So we do our best to take things one day at a time and try to determine if this is going to have a lasting impact. But ultimately, we're pretty happy with how we invest and how things run here. So. And we always appreciate your patience as we make those adjustments to your account so they work the way you want them to. And on a positive note, we're just a few weeks away from school getting back in session for my kids, and I think we're done with vacation. So we'll be in the office. If you have questions, reach out. If you want to get together for a meeting, a lunch, a breakfast, something, we're always happy to entertain those. So thanks again. We'll see you in a couple weeks, and take care.